President Trump has just proposed a revolutionary 10% cap on credit card interest rates. It's a move that promises massive relief for borrowers, but poses serious questions for the banking sector. Today, we'll break down the impact on your wallet and pick up on our ongoing conversation about the Federal Reserve. I'm Matt, joined by my co host, Nyamki Buchanan, and this is Road to Riches.
All right, welcome back to the show, everybody. This is a pretty big change that we're looking at right here with the 10% cap on credit card interest. To be fair, starting off, the proposal by President Trump is actually just a 1 year proposal, and we don't have a whole lot of details about how this is going to work. We don't know if it's going to be on existing balances or new balances only. We don't know, is it going to affect or is it going to supersede laws that already exist on the state level for things like this? For example, Oklahoma has a 20% cap, where other states may have a 30% cap, and I think the max in the country is somewhere around like 36%. But I mean, ultimately, this is something that could potentially do a lot of good, but I think that the unintended consequences might be, a little bit rough for what we're seeing here. What are your thoughts, Matt?
So, obviously, upon initially looking at this story, first of all, it has to be said that it seems like, for especially for young people, this move is a step in the right direction on one side of the coin. Uh, in an attempt to lower interest rates on credit cards, the president is essentially trying in Congress, because Congress would have to do something on the national level. Once again, you mentioned the states having limits themselves on credit card interest rates, and it varies state by state. And so, in order to do something around the board, Congress would have to do something nationally. And so, after let's assume Congress takes action and this happens, this 10% cap. Well, on the one hand, for young people, it would certainly help them, especially the ones in credit card debt. I know a lot of my friends, a lot of your friends probably as well. Uh, uh, they uh, they find themselves in a lot of credit card debt, uh, and it's hard. The principal balances add up. Of course, you're young. We all know what it's like to be young, and and so there's that on one side of the coin. It'll be easier for people to pay that off. On the other hand, though, we have to think about the credit card companies themselves and why those rates were so high in the first place. Um, it, we think about American Express and Capital One and Chase, Mastercard. These large companies, these some of them actual card issuers, and they're charging these high rates, and their justification for it is that eventually they're going to come across a person who legitimately doesn't pay their balance back. So a lot of us, and myself, and you as well, you pay your credit cards off every month. Every month you pay the balance and then you move on with your life. But a lot of people aren't like that, and so they build up these principal balances, and it's essentially unsecured debt. We know it in the banking industry as unsecured debt. There is no collateral, for lack of a better term. So that's the reason for these higher rates. And so, what is going to happen to credit card companies once they start? Because this does happen a lot. People, even past collections, don't pay. So, what happens when they don't pay, and credit card companies start taking these massive, massive losses? A lot of people will say, "Oh, these are billion-dollar companies," but um, uh, those losses add up. And for people like us, who pay our balances, who've been fortunate enough to have the wherewithal to do so, they only make money off of the transaction fees, but they really make their money off of these people who find themselves in credit card debt. Some would argue that's predatory. Others would argue that, well, it is unsecured debt. We have no way of getting this money back if you decide not to pay. And so my initial thought on it is that there's two sides of that equation. Personally, I think that it's a step in the right direction. The president's heart is in the right place in terms of getting people the help they need, but there is a risk to credit card companies as a whole.
I guess you're right about that, but I mean, you brought up a lot of things we do need to actually think about. Number one, you said, what happens when people with people that don't pay? Number two, how did these credit card companies even come up with the pricing? And then, of course, what if things just don't work out the way that the president intends? His heart can be in the right place all he wants, but if things don't actually work out, then maybe we should think about not implementing some of these changes. You know, as you said, Capital One or Chase or American Express or any of these other companies, they come up with these high, really, interest rates because they look at the credit history of the borrowers and they decide, number one, what is my actual credit risk with this individual, which is going to determine, kind of on a sliding scale, number one, whether they extend credit or in the first place or not. But then number two, for a lot of cards, you actually see that they offer basically tiers of interest rates. With the Wells Fargo card, for example, they may offer 19.99%, and then 24.99, and then 29.99%, purely because a less credit worthy person needs to pay a higher interest rate so that way the company can adequately account for that risk that they're taking on. um, number two, we do have an issue overall with people accepting debt that they either don't fully understand or don't really know how to pay back. So if you do take on a credit card that has a 25 or 30 or 35% interest rate, then a lot of people will look at that, basically think nothing of it, and then go spend willy-nilly. As you mentioned, we are, savvy enough and fortunate enough to be in a position that we can pay off our credit cards every month. But what about those that aren't? What about these people that are taking on uh, more what's essentially predatory loans to some degree, even though they are doing so with informed consent, but they're taking on additional debt with very high credit limits that they don't necessarily have a true understanding of how they work, and then eventually, they don't pay this off. It goes to collections. They continue not to pay it off. And now the credit card company is out that money. And that is an issue just overall with unsecured debt, like you mentioned. So I think that if a policy like this is enacted, we could very well get to a point where credit card companies will say there's no way that we can adequately mitigate our risk with an interest rate. We can't effectively price in the risk of these people, and so in the future, you'll have a lot of applicants that are now denied, regardless of their credit history, or rather, regardless of if they would have previously gotten approved, because now the amount of return in it for the company is significantly less. So a lot of those people will get disapproved, and unfortunately, in this country, we do have a society where the people who tend to need credit the most are the ones who are penalized for using it the most. So if we get to a point where someone with a poor or short credit history now cannot even get credit, then how can they, get 1 or 2 months ahead to be able to then use a debit card or even cash to pay for their daily purchases? We don't we basically use, and I'm sure you do too, but even even though I have enough to be able to pay off my credit card every month, I still use my credit card kind of as a short-term loan, to get from the paycheck at the beginning of the month to the next paycheck. Within that 2 week gap, I have bills and rent and other things like that that have to be taken out throughout the month. And so the credit card is essentially bridging that gap between that paycheck to the next. So what about these people that don't necessarily have those resources to be able to do something like this? Is this something that is going to more or less backfire and hurt the very people that he says he wants to help?
That's certainly a possibility. In terms of what you just said, the tier system, I want to use that as an example as to why you're correct. I think is so these card companies have tier systems, uh, oftentimes based on your credit score. So yeah, the higher the score, the lower the APR or the long time rate that you pay. And so those people who have the higher scores, I with this with this policy in mind, the people with the higher scores, I think, I don't know if they're necessarily going to be affected. But like you said, that's not who we're talking about. We're talking about the low scores, the people who need debt the most, possibly, or maybe these people you made a bad decision with credit, and they need a short term loan. Well, or they need a credit card. Well, they can't get accepted now because the floor or the ceiling rather is 10%. Uh, so what do these people do? Well, I actually, like I said in the beginning, agree with you that this would hurt them. Uh, the president's heart is in the right place, but as we well know, the road to hell is paved with good intentions. So the intention of bringing people possibly out of debt, even though this is, and we should caveat this by saying it's going to be a 1 year plan. He wants to do it for 1 year,
Right,
and
right,
then uh, after that, it's free range again, based on state. But again, this isn't helping those people. The government getting involved at such an intimate level with credit card companies, I don't think is necessarily going to be good, like you brought up, for those people who need those loans, those short-term loans, who may have made a mistake with their credit. It's not so good. Uh, and so, yes, I think that's a definite concern. So, what about those people, to finally answer your question? Um, I that would be a conversation for when this happens. I don't, as far as what I foresee happening is it creates a system where they're just excluded for a year, or they're required to do other things to build their credit instead of simply getting a credit card, paying it off every month, like college kids do, get a gas card or something like that, and pay it off every month at a low balance, and that builds their credit. I think they're going to have to do something else, uh, other than get that credit card. And that's going to be rather unfortunate, especially because a lot of financial institutions don't report to the credit agencies. Some do, a lot don't, though. And so uh, I hope that what we're saying doesn't come to fruition as a consequence of this policy. But we know this very well in economics. If you add a ceiling to a certain commodity, then then supply is simply going to drop. I mean, why would you supply something if you know that you're not going to get the kind of return that you want? And in this case, what about those lower credit people who are willing to pay higher interest rates, but they can't, because the government simply won't let them. They're willing to do it. They're trying to be responsible again. They're trying to just build their credit, but they can't do it because there's this ceiling now. Uh, as far as this policy goes, that's what I foresee happening. I don't know what you foresee happening, uh, but like I said, the president's heart is in a good place, but the road to hell is paved with good intentions, especially when it comes to government intervention.
yeah, yeah. I definitely agree with that. We all have our opinions on at what level government should be involved in, the economy, the financial system, and our lives in general. But you did bring up a couple of good things. Number one, I do want to talk about, since you mentioned it, is the credit score aspect. being able to build credit is something that all of us have to do, at some point. And if this proposal goes through and it does end up becoming a long-term thing, which is, entirely possible. I mean, I'm not going to say that, Trump is the first one to even, propose something like this. You know, Bernie Sanders, Elizabeth Warren, others like that, they've said something about this, earlier in last year, bills were proposed. Previously in years before that, things have been said. So this isn't necessarily a revolutionary concept, but when it comes to that long-term aspect of how do those who are excluded from the financial system because of this build their credit? I think number one, we have to um, look at what the parents' role is in this situation, because what my parents did, and I'm pretty sure yours did as well, and not all of us know about this, and for some people it may not be a good idea, but at least for us, my parents put me as an authorized user on their credit cards, which means from the day I was born, I now had and was building a credit history because they had the foresight to understand that I would need that later on. And since they were on time with their payments, they always at least paid the minimum, but generally never truly carried a balance. When I turned 18, my credit score was already in the 700s. And so I could get approved for quite a few things that other people may not be able to. So I think that's one of the first things that we should look at is assuming, you are a good and a responsible parent and you're paying off your credit cards on time every month, then you should add your children as authorized users. And this doesn't necessarily mean that you have to give them a card that they can go out and spend money with. Like I said, with what they did for me was they added me as an authorized user, and then when that additional card came in the mail, they just chopped that thing up so no one can use it. But the fact that I'm on the account was what actually mattered because I'm building that credit history. A second thing that I think is possible for young folks and really anyone at this stage is there is a massive buy now pay later system that the last few years has started to really take over especially online shopping sector, but even now even some physical locations are doing it as well. Not all of these buy now, pay later organizations do report to credit bureaus, but I know Affirm, they report to credit bureaus. There's another one like Sundance or something like that that I've seen that I know they report to credit bureaus. So if you do have some quote unquote large purchases that you have the money for up front, but you do want to build your credit history for, then maybe doing something like that, especially with, if you're offered a 0% interest rate for a certain amount of time, that may be something to look at as well. With that said, it's very easy to get caught in the trap of spending so much money that you don't have. And because you don't necessarily see your entire balance in one place, those short-term loans can pile up, especially if you use, a bunch of different lenders, and you can very easily get underwater when it comes to this debt and have it hard and have a hard time getting out of it. Of course, the same can be said with credit cards as well. If when I got my first credit card, I think my credit limit was like $1,500. So I didn't necessarily have a whole lot of money that I could go and spend and rack up massive amounts of debt with. But over time, as my credit limit did increase and I was still in college, I didn't always make great decisions. So I got up to a point where I had, 10,000 plus dollars in credit card debt that I was like, well, I have all this debt. What am I going to do? I'm getting charged interest. This seems very difficult to come out of. And fortunately enough for me, there were additional resources that I was able to take advantage of and eventually got a job that was paying enough that I could start to pay down this debt. So I think we all have to be very cautious when it comes to credit in the first place. And as you continue to take on more debt, you need to make sure that you're able to pay off everything and you continue to do so. We should never intentionally get to a point where we have so much debt that we can't pay it off. And even when you do make a very large purchase that you might have some equity in, such as, a car or even a house, then you still do need to take that with a grain of salt. You need to be able to say, even though I can afford this on the face, if at any point in my life, I get a an expense that is unexpected, or maybe I get laid off for a couple of months, what do I have in the background to be able to make up for this? Especially things with those large purchases. Your car could break down, you have to pay for it, and even if it doesn't, every year you still have to pay for your tag and registration. With your house, every month you have to pay towards your property and property taxes and insurance. So there are additional fees and expenses that we need to look at when we're coming up with our overall credit plan and how to maintain these things.
Yes, certainly. And you raised a lot of good strategies. The authorized user strategy for a lot of people, I think, would resonate, especially because it's very simple. Just ask your parents or another family member that you may trust. Hey, I need to build my credit. I want to be an authorized user on your account. And I think that this is a good strategy to do that and really have a conversation with them because, again, credit scores in the modern world that we live in is it's just important. A lot of people discount the importance, but I've seen its importance, and I'm sure you have as well. I know that certain people like Dave Ramsey say, "Oh, don't really worry about the credit score. It's just how well can you borrow debt?" And of course, everybody knows that he doesn't really like debt, but debt can be a very, very good thing. Like you mentioned at the beginning of the show, you sometimes need a short-term loan. Somebody's car breaks down. Sometimes they need a little short-term loan to fix it. And they're, by the way, willing to pay the interest rate required to get rid of it off of their statement. Or if they need a little extra time, they're completely fine paying 20%, 25%, or what have you. I think that, score as far as score management is concerned, we should definitely look for these smaller opportunities again as the young people are getting ready to buy a house, as they're getting ready to buy perhaps their first car is starting to get a little bit old. They need to go grab another car, go find a good deal, and they just need the best rate possible. And that's where the credit score comes in. That's where, and we can say this being from the banking industry ourselves, banks really do look at that. They may not look at it in the forefront. They may look at your income and your character first, but they definitely do want to see those higher credit scores to show them that, hey, you're not going to run out on them. This is you're a legitimate person, and you take your borrowing seriously. You're not dishonest with it. And so in terms of credit management, I think that credit management, score management, there's certainly something to be said there, certain strategies you can take. I myself just got one of the starter credit cards, one of the student cards, through my undergraduate. And as I moved up, I was able to get, a card with a higher limit. I will say this, that there's several factors that affect your credit score. And one of those factors is what percentage of your total credit limit do you use? So your credit limit can be 10,000, right? But you only use 500 down here. Or you use only 1,000. So you only use 10% of your total credit limit and on your credit card. And that can really make a difference. So, obviously, first factor is payback, repayment capacity. But the second factor right behind it is what percentage of your credit limit do you use? And so that's pretty important. Once you build up your credit, make sure to go for a higher credit limit, not because you're going to use it, And of course, this is where you have to be a little bit responsible, limit yourself a little bit, which you had to do with a lower credit limit. You can't change your lifestyle because you have more money available to spend. You have to get that higher credit limit because it helps your score. It When you repay your card, it acts as a magnifier to how much higher your score goes after every 3 months repayment. And so, I that's another strategy that people can use. I certainly think that it's important, and I believe you do as well. Uh, and again, I mentioned mortgages as young people, like myself, looking for houses and starting to really find our way in this difficult economy that we have. Another story coming out of the mortgage pool. So, according to CNBC, President Trump has asked Fannie Mae and Freddie Mac to purchase $200 billion in mortgage bonds. So, Fannie Mae and Freddie Mac are both government conservatorships, meaning that they're pseudo private. So they have shareholders, but they're technically speaking government entities. They operate under a government charter. Uh, and so the president has instructed these financiers to purchase mortgage bonds, not mortgages, but mortgage bonds, to try and alleviate the 15, 20, 25, 30-year mortgage rates. Uh, and I would like to point out that before I get to the technicals of what I just said, I would like to point out that just upon news of the action, because they haven't done it yet, mortgage rates for a 15-year mortgage have gone down by 22 basis points to 5.99%, which is the lowest since February of 2023. There's a lot to unpack, again, like I said, but this is, I think, good news. Just the news of these government conservatorships purchasing these bonds lowered the rates. And so, anyway, the technicals of what I just said is so Fannie Mae and Freddie Mac were created at times when the government was trying to get more people in houses. So Fannie Mae specifically was created in 1938. 1938, obviously near the height, if not the height of the Great Depression, a couple years before the United States joined World War II. Things were very, very hard in America, and people couldn't afford homes. Obviously, we know it in Oklahoma as the Dirty 30s. Not only did we have the Great Depression, but we had the Dust Bowl. And so we had a lot of people leaving, and all around the country, it was horrible. And Freddie Mac was created in 1970. Of course, everybody remembers stagflation in the 1970s and the so called war on poverty from Lyndon B. Johnson had made things very, very hard for Americans. And then a couple years later, America would get off the gold standard and it would make things even harder. It would inflate the currency even more. So that was the whole theory behind their creation. So these banks, conservatorships, buy mortgages from J.P. Morgan, from Bank of America, from insert bank here. And in theory, what that is supposed to do for banks is to free up lending space for the bank, free up capital. So instead of the bank holding those mortgages, because these conservatorships, they don't lend. What happens is they buy your mortgage from the bank, and when they buy said mortgage, uh, that what they do is once they have enough of them, they combine them into a mortgage-backed security or a mortgage bond. and they sell those to investors. And it's all supposed to be a self sustaining model that in the long run will lower rates for consumers. Why? Because there are more bonds in the market, or rather less mortgages. So the banks have incentive to give out more mortgages, and rates go down, or rates go up rather, because the bond prices go down because there's more of them. In this case, the president is instructing them to purchase the mortgage bonds themselves. So, not the mortgages, but the mortgage bonds. And so, what that will do is there's going to be less supply of the mortgage bonds. And because there's a lower supply of mortgage bonds, the bond prices will go up. And because of the inherent inverse relationship between bond prices and bond rates, the rates, in theory, will go down. And again, banks will be encouraged, because of the remaining demand but lower supply in the bond market, to give out more loans. And this would kind of have a domino effect. It would keep going on and on and on until rates got to their lowest point. In theory, that's how it's supposed to operate. Um, and obviously, it's working, right? So far, rates have gone down 22 basis points, and he hasn't even done anything yet. So, just from a purely apolitical standpoint, just looking out for, again, people our age, clearly it's had a good effect. I think we will see what happens in the market as far as external effects from the government using their funds to purchase bonds from investors who have already bought them. That remains to be seen.
Oh yeah, I mean, we had a very good conversation about this, kind of at length a few days ago, to talk about a lot of this and really go through how it works. And you had a great explanation, but I do want to say that we're not the only ones that think that this could benefit. I mean, CNBC, um, while they were reporting on this, they even have a quote from UBS analysts that says that they believe that $200 billion of MBS purchases could drive a 10 to 25 bips reduction in mortgage rates. And as you said, things are already coming down a few points already. Um, right now, they're the lowest they have been at the 5.99%, and things could go even lower. Of course, what the Fed does with the federal funds rate is going to impact that some as well. But as we get to a point here where now people are not having enough money, we're seeing that there has to be pressure on both sides of the coin, right? We have to make mortgages more affordable, and we have to make houses more affordable. And thankfully, at this point, at least for me, what I'm seeing down here in Texas is that over the last few months, they're reporting that housing prices have dropped about 4%. And I'm seeing that even directly in my own market, where now there are houses that have been on the market for 4, 5, or 6 months, and they're seeing ten and $20,000 price drops. There are more houses now in the DFW area that are in the $250,000 price range or lower, at this point right now, than we've seen in 2 years, really. There are houses that are now even below $200,000 that you would never anticipate being on the market. And it's not just in the city center as well. Even in the suburbs, we're seeing prices come down in Plano, prices come down in Garland, in Irving, in Arlington. Prices are coming down across the board. And I think that overall, we're seeing the same thing on a national level as well. I saw a post or an article earlier today as well that said that the housing market in Florida is starting to collapse. There was one property that was originally listed at $1 million, and over 2 years, it's gone down 76%. So I think that at this point, we're getting to where things are going to become more and more affordable, as the demand for these things starts to go down, and that's why we're now getting this pressure, from Trump to Fannie Mae and Freddie Mac to purchase these mortgage-backed securities to make the mortgages more affordable. We're going to see the Fed start to do more things right now with lowering interest rates, with making cash more available to the average person, to the potential borrower. So that way things can in the future get more affordable, and we can start to see our economy recover as a whole. And I think that's going to be a very good thing. But we want to do talk a little bit more about the Fed because I've mentioned the interest rates a couple of times at this point. And I think it's very important for our viewers to know how the Fed functions. So the main thing that we need to worry about from the Fed are those interest rates. They control what's called monetary policy, and so part of that monetary policy is setting the federal funds rate. This is basically the lowest interest rate that's available in the country because this is the interest rate that banks directly pay the Federal Reserve whenever they need to borrow currency. Um, so at this point, there are also a couple of other things that they do, right? They also control reserve amounts that banks have to have on hold. For many years at this point, the Federal Reserve has actually required no reserve for banks. But previously, we've seen percentages such as 5, 15, even 25%, where the Federal Reserve has required these banks to say we're not going to lend out all of our possible money, and that has essentially made it so that number one, you're tightening things right now so that people have less money to borrow. Right, the supply has gone down, so rates are going to go up a little bit naturally, but that's also going to end up lowering inflation because things are harder to buy, they're harder to come by, right? If they were to lower the that reserve requirement, then now the banks can lend as much as they want or as much as they have, that is, and prices are going to start going up a little bit. There's more people that buy. But with that, they can also do what's called quantitative easing and quantitative tightening. And basically, what you have, if you think about it from the side of the money supply itself, with the easing, you're increasing the money supply. With tightening, then you're lowering the money supply. So, what the Federal Reserve will do when it comes to the side of easing, since they want to increase the money supply, what they will do is they will actually take their bonds and other assets that they have on their balance sheet and sell them and excuse me and buy them from the open market. So they are taking their funds and putting it out into society in exchange for bonds and other assets that's on the open market. When it comes to tightening, they'll do the opposite, right? So they will sell their bonds and other assets to the public and take money out of the economy. So those are the main things that they do in order to control the flow of cash and interest rates and things like that, because they state that their main goal is essentially to, number one, control interest rates, and number two, to maintain a high employment rate. And that's pretty much how they do that.
Yes. So the Federal Reserve in this little not in this little cat and mouse game of controlling how much currency is in the United States, how much free flowing currency is out and about in the economy in terms of buying in terms of buying treasuries and selling treasuries. Uh, so this is how they control those interest rates. And so when they come out and say, "Oh, we're going to lower rates by 25 basis points," for example, they know exactly how much treasuries they're going to sell. They've gotten very, very good at this over the years. And one thing I want to point out as well, in terms of the Federal Reserve and what they look at, so when considering rates, that is, what they look at, the Federal Reserve will aim for a 2% year over year uh, inflation rate. So they want the currency, the US dollar, the Federal Reserve note, to deflate, or I'm sorry, inflate at 2% per year. And that's their goal. And what they say their reasoning for that is they want to avoid some kind of deflationary effect. So they want to avoid a situation where all of a sudden goods completely fall in price. And while, economically that could be a very, very good thing, it could also be a very, very bad thing. They could The producers would go out of business, possibly, if everything happened at once. And so that's why they try for that 2% rate. Obviously, that it leads to a whole different discussion that we don't have time for today, as far as whether they're right or whether they're wrong and what certain economists say about it. But that's what they look for. And so what they look at is a a metric called the consumer price expenditure. So you'll see in the news a lot this consumer price index. And what that index says is how what prices of goods have done year over year, and what people are buying, how much of certain industries are people buying, and that's what that CPI will look at. However, the CPI is flawed because it doesn't account for, say, steak has gotten really expensive. And so people move to chicken. It doesn't account for substitution. And that's where the consumer price expenditure comes in, because it adjusts. It adjusts for people who substitute steak for chicken. And they say, okay, well, uh, what is and so they say, okay, well, what has steak done to make them change over to chicken, and what has chicken done over the past year? And so we'll consider chicken's rate as steak's rate, or something like that. And so, I say that just to say, you see CPI in the news all the time. That's not It's a very good metric, but it's not exactly what the Fed looks at. It's kind of like it's kind of like um, GDP versus GDP versus adjusted GDP versus unadjusted, a net
Yeah,
versus
it's
gross.
it's
That's
like
kind
that
of
that basket of goods idea that they talk about. Yeah.
exactly. And so moving on from that, the CPE, the consumer price expenditure, is sitting around 2.5 right now. And so my thoughts after looking at that, and after looking at what it was when they lowered rates previously, is I'm pretty sure they're going to lower rates this next time. When they meet on the 28th, that 2.5%, they're going to say, okay, good enough, let's lower rates. Usually when it gets up to 3.5 or 4%, at 3%, they're cautious. But once it gets to 3.5, 4%, that's when they don't do anything. And when it's above that, they raise it. And so in terms of what the Fed is going to do and why they do it, that's what happens. In terms of who meets to make these decisions, it is actually a combination of some of the Federal Reserve Bank's um, uh, chairman, but mostly the board of governors that is appointed via executive nominee process here in the United States. But some of the Fed presidents, like the Federal Reserve Bank of New York in Manhattan, or the Federal Reserve Bank in Washington D.C., and then there's a Federal Reserve Bank out in San Francisco. I think that the San Francisco president also meets, but if he or she doesn't, then it's four. It's seven board governors and then four presidents. And so that's who's making these decisions. They had to incorporate the actual presidents of said Federal Reserve banks, because they're the ones who have a bird's eye view of what their specific branch is lending at the discount rate. And On that note, the discount rate is actually what the Fed adjusts, not the interest rate, that the prime rate that we see, the 6.75%, as it is currently. The Fed doesn't. They're not changing that. What they're changing is the discount rate, which is the rate at which the Federal Reserve banks can lend to commercial banks. And So I think they're going to drop it by another quarter, but maybe they say, okay, well, 2.5% close, but no cigar. Um, but this story from the president, from Fannie Mae and Freddie Mac, I think is a very good start and maybe put some downward pressure on the market.
Yeah, it'll be very interesting to see what the Federal Open Market Committee does next week. Hopefully, things trend a little bit better, but you never know. So, a big question in that case is, what do we really do? Based on these decisions, and I think this is something that matters pretty much all the time, right? Because you will get because at every meeting they meet basically 8 times a year. At every meeting, you have three possible options for what can happen. Either the board will decide to keep rates the same, they'll lower rates, or they will raise rates. And what you do as an individual should somewhat be decided based on those decisions. For example, of course, if they keep things the same, then that's a pretty easy decision, right? You just pretty much continue to do as you had been doing. Um, there's not really many places that you can look for to change up your investment strategy or your spending habits. You have to pretty much look at individual purchases rather than those contracted expenses that you have. Contracted expenses going to be things such as a credit card, a car loan, mortgage payment, business loan, things like that that are that the pricing, that is the interest rates, are kind of pegged more or less to those interest rates that the banks are having to pay to be able to borrow funds. Um, so really, we have to look at what happens when rates get lowered, what happens when rates go higher, right? So when rates get lowered, as you mentioned earlier a little bit, with the seesaw with the bonds, as rates go down, prices go up, right? So in the short term, that's actually going to be a pretty good thing for people who have a significant amount of bonds. If you say, well, I no longer like the interest rate that I'm getting, I think I can go somewhere else and get a higher interest rate with a different asset, then now you can sell those off into the market for a higher price than normal. And then you can turn around and look at something that's a little bit more attractive, which is going to be something like a regular derivative, such as, a stock or something like that. Um, if you're someone that has a lot of CDs, certificates of deposits, or something like that, those are probably still going to be attractive. Number one, because there's a penalty if you withdraw early, but number two, because you actually lock those in at a higher rate. At this point, things may, those fixed income securities or other products may not necessarily be what you want. Like I said, interest rates on bonds are going down, interest rates on savings accounts are going down, interest rates on CDs are going down. So you might not necessarily want to look there unless you just still feel like you need that level of security. Because that is one of the good thing with those products, is that because they pay so low, the risk is also very low as well. So you're fairly well matched at that point and can hedge against other things that you might think of. And then the second thing is, when rates go higher, well, now kind of the opposite is true, right? As rates get higher, then now your bonds are going to be a little bit more profitable, your CDs are going to be a little bit more profitable, your savings accounts are going to be a little bit more profitable. And if you even want to be a little bit riskier, then you can push a little bit more and go for a money market account or something like that. And because you're still going to have a decent level of protection there, whether it's FDIC insurance in case the bank collapses, or whether it's the backing of the government with those treasuries and things like that, those are going to be, for a lot of people, a better idea or a better investment product than a standard stock investment. But really, that all depends on what your strategy is right now. What's your financial position? What are your goals? And what's your risk tolerance? All those things, they mix together to come up with a particular blend for you of how much you need in low risk securities, how much you need in high risk securities, or if you want to even look at alternative investments, um, such as, if you have access to it, private credit, private wealth, real estate investments, or even a real estate investment trust, things like that. So there are a lot of options that you have, but you should start to continue to look at what's changing in the economy, based on what the Fed does, based on the macro economy, the things that you see around you, and that's going to be able to kind of allow you to tailor your investment and saving strategy and your spending habits as well to that. And if you have, specific questions, obviously we're not able to give, very detailed individual advice on the show for federal reasons or legal reasons. So I would definitely suggest, get in contact with a wealth advisor or someone who's local to you, who can talk about these things. There are at many large banks or even online banks, they have systems in place where you can speak to a financial advisor even if you don't have a lot of money, and they'll be able to look at your specific situation and circumstances and say, this is what I think you should do, this is how you should structure yourself. But as a more general rule, when you're younger you can be a bit more risky, and then as you get older you want to slowly back away from those more risky things and put them into more safe investments. That way, as you approach retirement, then you're not necessarily worried about, well, what happens if my portfolio goes down 50%, because you're already protected from that possibility.
Right. And that touches up on a very important investment strategy with what you just said in mind, called diversification, in which, as you get older, as your portfolio grows, as a consequence of you putting more money into it, you your strategy should be to diversify to lower your overall risk. So that way, as you get older, your risk moves from up here down here, and it's never zero. It's not going to be zero, but you can at least lower risk based on your holdings in higher risk investments and lower risk investments to bring that average risk down. And that is an incredible strategy, I think, personally, in terms of making sound investments, making investments that make sense. And we hear of these stories in popular culture about these people who went, oh, I invested in Netflix in the year 2000, or Facebook when it first came out. I guess and sorry, Netflix would have been closer to 2008, 2009, and the stock just shot through the roof. Well, let's be honest, we hear a lot about the winners, but we don't hear about the losers, and there's a reason for that. And so but there's a lot of losers, and so this whole idea that I'm going to get into the stock market and I'm going to make it rich and I'm going to hit the right stock. Well, first of all, what are the odds of that happening? And then second of all, what are the odds that the opposite happens? What are the odds that you throw all your money at something that you really believe in, and it just it goes south very, very quickly, so quickly that you're not able to pull your money out in time? Hopefully you do it before this happens, but if you're not, it just takes all of your money away. At the end of the day, it is an investment, and investments are you putting money in and not and not getting an immediate benefit from it. It could pay off, it could not. And so that's the scenario in which, again, talk to your local advisor, talk to somebody in this field who you've grown to know, or even better, to trust, and ask them, say, hey, what do the risks look like with this investment? How can I lower my risk the greatest? And that what they're going to tell you oftentimes is the diversification strategy, which they're going to say it because it's tried and true, and that's how 401ks work. That's how IRAs work, and that and a healthy investment into bonds, which again is another conversation for another time. Uh, but these are the kinds of things that young people like us can take to, again, the whole purpose of all of this, to try and make what we can out of the economy that we have. And it's unfortunate, but it is what it is. We have to live with the consequences of uh, of previous generations. There's no other way to say it. But let's also not be completely nihilistic, completely pessimistic, I should say, and say that there's just no point. It's so hard, so let's not try. There are people in this world who think that, and I think that that's a mistake. I think that you're not going to add any time to your life by pretending that it can't be done or saying that it can't be done. And again, I'm with you. It's hard out there. It's hard for everyone. It's hard for me personally. I'm sure it's hard for my co-host, but at the end of the day, it's about getting out there and doing what you can with what you have. And I think that there's a lot of strategies laid out here that certainly benefit people long term, will benefit you long term, as long as you can be smart about it, stay disciplined, and keep moving forward.
Oh yeah, oh yeah. Lots of good advice in there. Um, I at one point did try to be the guy that caught on to the waves and get the high returns, but you know I had losses just like the greatest wealth advisor of all time, Warren Buffett. Warren Buffett, he also had losses. So no matter how much you're never going to hit all of them. And no matter how much you're always going to lose sometimes. So you just have to understand that and be prepared when you do take that risk, which is why, as you said, it is very important to talk to someone in the industry, a financial advisor, a wealth manager who will guide you along in this process. And as you learn more, then you may be able to do some more things yourselves. But um, it's just very important for all of us to be able to sit down and be honest with ourselves and look at what's happening in our lives and in the greater economy and make sound, knowledgeable decisions based off of that. Um, but at this point, I'd say that kind of wraps up what we had to talk about today. Wraps up how we looked at these new credit caps and the mortgage bond directives and how they're going to shake up the economy, the things that we can look forward to with the Fed. Join us back next time, next Thursday, because we're going to talk a little bit more about the market's reaction and how you get fully prepared for the Fed meeting at the end of the month. We're going to talk a little bit more about these different products and how you can, better diversify or structure your portfolio. But if you have a question, leave a comment. It might get featured on the next episode. We are going to read all of those and we are going to respond to them either in text form or on video form. Um, from my co host, Matt White, and myself, Niamki Buchanan, thank you very much for listening. And remember, like this episode and subscribe to stay involved with the podcast and to stay on the road to riches.